With 2023 drawing to a close, let's take a look at what we can expect from oil prices in the new year. Hello and welcome back to our channel. My name is Daniela. And in today's video, we are going to be looking at oil prices to see what we can expect from a fundamental perspective from oil prices in 2024. But first of all, as always, please like this video, comment, subscribe, and turn on your notifications. And if you have any questions about trading or the markets, feel free to leave them in the comments below in the section. We'll try and get back to you as quickly as possible. So oil in 2023, it's been a bit of a roller coaster ride, not just for oil and commodities, but markets in general. We've seen quite a lot of move across the broad base of markets. But heading into the end of the year, especially this month of December, we have seen a bit of a change of mentality in markets across the board. Now, a lot of this change of mentality actually coming from the central bank meetings that we saw last week. So the main driver of this change in mentality, especially in oil prices, as you'll see in the charts in just a second, we have turned and reversed higher over the last week, was the fact that the Federal Reserve on Wednesday indicated a little bit of a dovish tilt that was unexpected by markets. In fact, Powell all but assured markets that rate cuts are coming in the new year, and that has led to repricing in expectations, with markets now anticipating a cut sometime between the first quarter and the beginning of the second quarter in 2024. And of course, that impacts money markets, and it has impacted as well sentiment in commodities. As we know, oil is very volatile and very sensitive to economic developments. And of course, expectations that rate cuts will come in the US in the very short term has impacted expectations for demand for the commodity. So that is one of the main drivers of this change in momentum that we'll see in charts in just a second. So the Federal Reserve being more dovish does essentially allow commodities like oil to have a better growth expectations in the next few months, because lower rates do free up costs for consumers and therefore do lead to growth or boosting growth in the economy. That is the whole point of lowering rates after a period of such elevated inflation and dare I say, subpar growth. That is not the case in the US. We've seen growth in the third quarter extremely high in the US, especially if we compare it to the likes of Europe. But nonetheless, expectations is that such high inflation for so long will have dampened the economic situation of most households in Europe and the US, and therefore lowering rates is the way to go. At least that is what the Fed seemed to give away at the meeting. Since then, we have seen some FOMC members coming out and trying to push back on some of the market reactions that we saw, saying that rates are likely not to come as soon as expected. But nonetheless, markets have now taken the view that rate cuts are coming sooner than expected. How many rate cuts we see next year is going to be a key factor in determining asset prices and oil prices next year. Markets are pricing in 6 25 basis point cuts in 2024. The Fed dot plot suggests around 3. So there is quite a bit of a disparate realization of how many cuts we may see. I think the Fed's prediction anywhere between 3 and 4 is more realistic at this point, given the economic landscape. Of course, that can change. In my view, if we do see 6 rate cuts like markets are predicting, that essentially means that some of the worst forecasts for the economy have come true, and that isn't necessarily good for oil either. So I would say rate cuts is good for oil, but as long as they're gradual and they're not giving the impression that the economy is actually in a much worse shape than we were expecting, that could weigh on oil prices as well. So it is a very tricky balance of trying to keep those expectations high whilst also lowering financing conditions in the economy. So we saw that on Wednesday last week. That started a big reversal, a big change in mentality. On the following day, we actually saw the IEA, so the Energy Administration, coming out and saying that their forecast for oil demand had actually grown in 2024. That sparked another rally in oil prices, which has continued pretty much to this week. And they were essentially saying that they are revised higher their growth expectations for 2024. They are now at a growth of 1.1 million barrels per day. So they added an extra 130,000 to their previous expectations. And that, of course, they said, boosted sentiment in oil markets. That is quite a while away, far away from what OPEC's official expectations are, roughly about half. OPEC expecting growth in 2024, demand growth to be around 2.2 million barrels per day. So there is quite a disjointment there in expectations between the IEA and the OPEC. That is not uncommon. The IEA has been a lot more conservative and a lot more bearish in terms of oil prices recently compared to OPEC. But in general, expectations for growth across the board seem to be higher in 2024 than in 2023. Now, what's actually going to happen will depend, as I said, of course, on interest rates, will depend on economic data. Now, China is a big player in the demand situation. So forecasts for China have been quite dire recently. Data has been quite underwhelming. Is there expectations for that to improve? There is. We have seen retail sales improving. We've seen industrial production also improving. So expectations are a little bit better for economic forecast in China. That, of course, feeds into a better prospects for oil as well. So China's going to be a big determinant of oil prices in 2024. As I said, rates as well, and how expectations about rates and the economy go. So that is going to be very key going forward. Now, another thing to take into account, of course, the performance of the US dollar. We have seen the US dollar drop recently on the back of that more dovish Fed. That has aided oil prices higher. So the performance of the dollar is something to take an eye out, something to consider in the new year as well. Of course, a weaker dollar makes it cheaper for foreign investors as well. So it could improve the demand prospects for the commodity. Something to keep an eye out on as well is the supply side. So we know throughout 2023, we've seen supply cuts coming from some of the big producers, Saudi Arabia and Russia being two of the most important ones. They are forecasted to continue in 2024. Do we see an increase in those production cuts? Do we see that change? That will be a factor to consider as well. I think for now, we're not really expecting it to change that much, but we could see some of that in the next few months. Also, supply shocks, external geopolitical factors, those are very hard to predict. But those, of course, could be a bullish signal for oil prices in the next year if something were to happen. We have seen an increase in ship attacks in the Red Sea recently. No oil tankers have been affected yet, but if that situation escalates, we could see oil prices picking up on the back of that. That is more in the immediate future, the short term. But for 2024, I think most of the forecasts are expecting to see average prices around $80 per barrel. I think roughly where we are right now, there isn't expected to be too much volatility. It's just a case of that playoff between demand and supply, how quickly demand can recover, how will economies perform as central banks start to cut rates, and will we see growth pick up? Are they going to have to cut more than expected because growth is going to perform worse? All of those factors are going to be key for oil. In the short term, it looks like it's a bullish pattern. It looks like the path of least resistance is higher on the back mostly of that dovish Fed, weaker dollar, and expectations of more growth. But of course, that can change in the coming months. There is a lot of economic data that comes out in Europe, the US, China, all that affecting oil prices as well. So the forecast for now, pretty good, just to see an average performance next year. In terms of the technicals, if we use West Texas Intermediate, so US crude, as our benchmark, you can see here this turn in momentum starting last week. As I said, this was on the back of that Federal Reserve meeting on the 13th here. The upward revision in growth forecast on the following day, really just culminating in this bullish reversal that has been playing out quite nicely. We did see a little bit of indecision here creeping in on Wednesday, so yesterday, seeing a little bit of a short-term top there. But nonetheless, as I said, the short-term expectations are for this bullish bias to continue. The RSI is now just hovering below that 50 line, so finding a little bit of resistance here. But if we do cross above 50 and we do see those higher highs and higher lows continue as the trading days go on, then the prospects, as I said, are pretty good there in the short term. We do have some resistance up ahead. We are still trading below the 250 and 100-day simple moving averages. So expect to see some resistance in the longer term. We could as I said, struggle to actually capitalize on those gains. The average performance is expected to be roughly around $80 per barrel, to see a little bit of sideways move along there, and potentially some dips and peaks above that. But we do have a while to go there. And as you know, for WTI, $80 or 80.6 and 82.5 is a key resistance confluence area that's been very important in the past. So if we do manage to get there, it's likely that we do see some consolidation, some struggle, potentially some sellbacks, some pullbacks and sell-offs coming from there as investors start to question the sustainability of further moves. Before we get to that area, though, as I said, we've got some moving averages to tackle. So the momentum has started to fizzle out a little bit. I wouldn't be surprised if around this area we see, as I say, some somewhat sideways consolidation, potentially a little bit of a pullback. We are coming into the holiday period. We do see reduced liquidity. So that can sometimes lead to exasperated moves. If we see any news coming out on those days, we could see quite a bit of volatility over the holiday period. There are a few things out there that could affect it. But for now, it looks like we are trading at what is fundamentally quite a sound area here, just around that $74 mark for WTI. Short-term bias to the upside, but likely to be some further resistance from there. That is it for today's analysis on US crude. Thank you so much for watching, and don't forget to subscribe to our channel.